everyone, and welcome back to the PetroNerds podcast. This is episode 84 of the PetroNerds podcast. My name is Trisha Curtis. I am the CEO of PetroNerds, and I am the host of the PetroNerds podcast. So today, another special treat for you. I'm going to do an introduction and recap of the market. It is May 22nd, 2023. It is Monday. It is the evening right now, and we have seen a lot of volatility in a few buck range for oil prices, largely because of the debt ceiling talk. So last week, I gave an introduction to the podcast, and we talked about the looming debt ceiling talks and all the politics involved. This is still an ongoing thing. We had Joe Biden in back and forth having conversations, cutting short meetings in Japan and Hiroshima with the G7 because of the debt ceiling. So lots going on there, and we'll talk about that and where oil prices are at, the volatility around that, and what's going on with yields and things like that in that nature because of these debt ceiling talks. So this podcast, however, is a part one of an absolute soup to nuts conversation. You're going to totally enjoy it. This is the presentation that I gave to the Society for Petroleum Engineers Midland Basin, Permian Basin chapter in Midland, Texas. It was an absolute treat. Super, super fun presentation and talk. I open up this talk by talking about the groupthink in the industry and asking folks where they see oil prices. And predominantly everyone in the room really saw oil prices going north. However, they did not feel the same way about demand. And that's where throughout the presentation, I walk folks through that of why you would have high oil, why you can be bullish on oil prices, what supports that bullish thesis and what doesn't support that bullish thesis. And the demand side does not support the bullish thesis. There are many elements that support higher prices, but those can be pretty volatile. All right, so the presentation was recorded on May 2nd, earlier this month. It is it's still extremely timely. That day, we had prices come off between 5:30 in the morning when I did put the slides together for the presentation to the afternoon when I gave it. Prices had come off a few bucks because of Chinese demand concerns. So just it's a note of how we're seeing these few dollar swings in oil prices, which are really serious. So as of today, big news was that Chevron buying PDC here in Colorado. We'll talk about that in this introduction. The debt ceiling talks, though, I think we really need to talk about that, and that's that they're ongoing. So, in last week's podcast, I was talking about how Janet Yellen had made the comment that basically it's June 1st or beginning of June-ish. And she's reiterated that that's when we start running out of money. Now, to actual default on the debt is to actually not make payments. That's a default. So there's a lot of volatility in the market. You're not seeing quite baked into stocks, right? They're not baking in that we're going to default on our debt. The short-term rates that we are seeing and the volatility in oil prices, we are seeing that. So when you see positive sentiment come out from the anything positive in the news, depending on if you turn it on in the afternoon, if you turn it on at night, if you turn it on in the morning, whatever's coming out between McCarthy and Biden, if that's positive, oil prices go up. If that's negative, oil prices go down a little bit. And it's not saying that they think it's going to default. It's just what this means for the economy. And as I've mentioned before, oil is being traded, and it's being traded as a sort of recession and economic indicator. So right now we are seeing WTI at $71.99 as of May 22nd, 2023. We are seeing Brent at $76.50. We're really seeing that narrowed, really nice narrowing of that Brent WTI spread, which I think is probably helpful for a lot of folks on the midstream side. Henry Hub is at $2.39. We have seen a massive drop in Dutch TTF. Dutch TTF right now is under $10. It is at $9.42. I think that is extremely important to just put into perspective, folks, that we had $100 NEMA BTU in just August of last year. And I was working with clients that were in Europe last year. And it was very hard to get folks to appreciate that prices would likely really come down, not necessarily to these levels, but that you wouldn't maintain those high levels that we were seeing last summer. And here we are. Now, I'm not saying I, forecasted a warmer winter by any means, but volatility in gas prices and just volatility in commodity prices really, really important to appreciate when we're thinking about this business and the nature and the boom and bust nature of this business. That being said, so, big pressure on net gas. Now, the yields. So with all this debt ceiling debate and this stuff talking, what you're hearing overwhelmingly in the market, just to summarize for you what I listen to day in and day out, is that most analysts are not projecting that, nobody wants to default on the debt, right? That is not something anybody wants. And it would be very bad for the US economy because you would have to start thinking about payments, which payments you're making, which payments you're missing. The big bad part would be that is if our credit rating, what that means for our actual standing and an actual real default, as opposed to, kicking the can down the road in extension. And what we're likely to get is, and potentially, I think this is what the Republicans and McCarthy don't does not want to do is sort of agree to what the Democrats and Biden want, and then say, "Oh, in September we'll work on this," because you're just kicking the can down the road, and then will they actually agree to it? And so we have big problems. We have a lot of spending. We have a lot of inflation. And that is something that I think we do have to appreciate in yield. So we are seeing the 10-year yield has really come up. It is at 3.721% right now for the 10-year. That has really come up. We are seeing the 30-year mortgage is almost at 7% now. We're back at 6.95%. So when you hear all this talk about how, you can literally do the same thing on almost every news piece and hear a positive story and a negative story, especially for home builders. When mortgage rates go down, home builder sentiment goes up. And that's the home builder sentiment going up this quickly, given that we haven't had a fallout in home prices, is pretty ridiculous, right? We cannot have that positive sentiment, and that is what's fueling inflation, and that's what inevitably is going to cause this all to drop, and that in commercial real estate as well. But those high mortgage rates and the high rates that we're seeing for short-term treasuries for the 1 month, if you're looking at a 1 month CD or 3 month CD, you're looking at over 5% yields on this, and that is baking in this risk and volatility that we don't yet have a debt ceiling deal. So that is really serious. Again, I'm not going to go into this until, it's very ongoing. So where, Janet Yellen coming out and reiterating, I think part of why she keeps doing that is that, really putting a sense of urgency that we have to come to a deal, that we have to make our payments. And that is really serious. So that is ongoing. We will be coming back and talking about that. Chevron bought PDC. Obviously these companies have a lot of cash, so it makes sense. PDC is does have assets in the Permian, but they're also a very big player here in Colorado in the DJ Basin. When you buy a DJ company, it is really about buying permits. I know folks don't want to say that, and PDC is a well-run company. They bought Great Western. When they bought that Great Western purchase last year, that included, they had drilled but uncompleted wells in there. So, but they were purchasing Great Western because they were purchasing the permits. Because after SB 181 in Colorado, which passed in a couple of years ago, after that was pushed through, we have had a massive reduction in permitting because it's very, very hard to get permits here in Colorado to drill oil and gas wells. So a lot of this consolidation was driven off a very strict regulatory environment, the inability to get permits. I talked about that with Daniel Seaver in previous podcasts. Definitely worth taking a listen. So that consolidation, though, it's not positive for Colorado business in terms of oil and gas production. It means that if we're thinking about where big publics are, they reduce output. And so I don't think you're going to see less activity in Colorado. PDC has been drilling with several rigs in Colorado. They've been really leading the charge. So you have seen Chevron buy them now that at over $7 billion. We'll be talking about more of that in the future, I'm sure, with guests. But that means that there will be consolidation and there will be job losses in Colorado, typically with every purchase and consolidation. And I really do blame that's a good buy for Chevron, but that is not a good sign for the regulatory environment in Colorado. And I think, that all the restructuring from the COGCC, the Colorado Oil and Gas Conservation Commission, has driven that forced consolidation for the need to get permits. We wouldn't have had the consolidation we've had in Colorado if companies could actively get permits. And that's not good for business, just overall and in general. So Jamie Dimon, the two things I'll talk about the market real quick before talking about what we'll be getting into within this podcast is, so Jamie Dimon came out and he said that he used a 7 handle on interest rates, that interest rates could go as high as 7% because he's been on the record from Davos earlier this year and even before saying that we have sticky and persistent inflation and the interest rates could end up going higher than a lot of people expect. I've been in that camp for a long time. Not that I think the Fed is doing a good job of articulating that and letting the market understand it, but that the inflation is very sticky and persistent, and it's hard to get inflation down, and it's really, really important that we do. And that housing piece I was talking about is a critical component of that. Now, and the Fed is pretty lost right now in how they're thinking. We had a couple comments come out from hawkish comments from the Fed, from different Fed folks saying that they think we're going to have a Fed rate hike. Now, we had in this podcast that I talk about, it was the day before we had a Fed rate hike of 25 basis points. And we have where now folks are talking about a potential, not a pause, but the Fed actually not having a meeting in June and then hiking rates later. So I think it's just buying them time. I don't think Jerome Powell's doing a very good job. He's not articulating well to the street what's going on, and we're seeing this volatility. You literally had you in March, you had folks betting on a 50 basis point rate hike. Then you had your banking crisis begin, and then you had the market base baking in rate cuts, and now you have folks like Jamie Dimon saying 7%. that is pretty all over the map. So that's really serious. That's not giving the market clarity, and it's hard. That makes things difficult and hard. And you do see some. I mean, depending on how strong the dollar is, you do see weight on WTI on oil prices as well. And lastly, I'll just note, really watch the China space. The Chinese debt story. Bloomberg's had a couple of articles on this of. The big Chinese debt is huge. And the reason that matters is because, they ripped off the zero COVID Band-Aid. Everybody thinks that we keep waiting for this good data to come in. It doesn't come in. China cooks the books anyway on the data, but that data, positive data, is not coming in. And we would have seen that impact oil prices. And, OPEC cut prices, cut output going into recession, partly because of the China story and it not being as bullish. Interesting to me, at the International Energy Agency is baking, they're saying we're going to have a rising demand in the back half of this year, basing that on Chinese demand. I don't think that's probably accurate. I don't think we have, the China story is very messy and we don't have a lot of color in data. And so right now it's being service driven. We're not seeing this big growth. And partly that's because they have so much debt and that they can't just throw in infrastructure. They can't just throw, infrastructure and spending at this. And, they could also be wanting to do other things and planning for other things. And that's volatility that folks are not baking in as well. And then there's just ongoing tensions within the U.S. So they put a ban on Micron, or impose bans and implications for Micron for the chips, saying that this is a security risk in China. This is a tit for tat going back and forth. We've seen Montana ban TikTok. Chinese TikTok is actually suing them. That's just completely hypocritical, given a country that doesn't have rule of law, and you can't actually do that in China. But the point is, there's a lot of back and forth. There's a lot of tension, and so when Biden comes out and says he thinks those tensions are going to be eased, I think that's pretty ridiculous. But we did see, Biden was in Hiroshima, in for the G7 meeting. There have been increased G7 communiques on energy that have come out. They have not been positive. They haven't been really strong on anything. I'll be talking about that more later in future podcasts, and definitely talk about it in this one as well. So within this podcast, before I let you go and take a listen, this is part one of this Society for Petroleum Engineers Midland talk I gave in Midland on May 2nd. This is a complete soup to nuts presentation. I will be posting the whole thing on YouTube as well, but I'll post the second half of this and put an introduction to this for next week's episode. But this is, I opened this podcast out with talking about, where do folks see oil prices? And sort of doing this to reiterate where I see the industry having a real groupthink around higher oil prices. And not having a group, but not being bullish on demand, and how that's really problematic. And I talk about this also in the context of investor pressure and ESG in the energy transition, and why it is so important for oil and gas companies to start explaining to the street that their product is going to be demanded, and why they need to produce oil and gas, and giving the investment story, because they're not giving a great story when they're talking about ESG and the energy transition. And that's leaning into the net zero stuff, which net zero is a 25 million barrel a day demand drop by 2030. And that's not a good story for a case to hold oil and gas companies in their portfolios. So there's a lot of messiness in terms of anti-oil and gas movement and the pressure on public companies, and also what the public companies are saying. So we get into this a lot in this presentation. It is literally soup to nuts, from everything going on in the world to everything going on in US Shale to what's going on in the US economy. I really think you're going to enjoy it. The second half, which I'll have next week, we have great Q&A, which I include in the conversation. But so in this podcast, we'll talk about G7 energy communique, what's going on in Japan, why that matters. We're talking about the Strategic Petroleum Reserve, the pressure from the regulatory environment, and really the investment thesis, and how this is weighing into investment and public perception and operator behavior. And we do get into the very low reinvestment rates in shale, and what that means. So, and how that does play into actually the bullish thesis as well. So really hope you guys enjoy this. Thank you so much for listening. Talk to you soon, folks. Bye.
I will introduce our awesome speaker for today, Ms. Trisha Curtis. Trisha is the president and CEO of PetroNerds, a company she founded out of Denver in 2016. At PetroNerds, Ms. Curtis leads research and consulting services. She is a macroeconomist with an expertise in US shale markets. She also hosts the PetroNerds podcast, which I highly recommend. Trisha completed her undergraduate work at Regis University in Denver, where she double majored in economics and politics, minored in criminology, and graduated summa cum laude. She has a master's from the London School of Economics in International Political Economy, and wrote her dissertation on Chinese national oil companies. Raised in Northwest Colorado, she grew up around pump jacks and has worked in oil and gas sites in Colorado and Wyoming with her father. So please help me in welcoming Ms. Curtis.
Thank you very much, and thank you specifically, Taylor, because you invited me to come speak here. And actually, I have spoken at a lot of places around the world, and I was pretty excited to get invited to come to Midland to speak, because I am an oil field girl, and I love pump jacks. So I was very excited to fly in. I would literally fly into Midland just to look out the window and see the pump jacks. So you'll have to bear with me a little bit today. If my hair's a mess, it's because I was in the field earlier, which was awesome, and had a hard hat on, and managed to change clothes really quickly and then head over here. And the slide deck, as all of them are, is way too long for an hour, but I have to give another presentation after. So, and woke up early this morning. The world has changed between when I woke up and now. Oil prices have backslid a few bucks, so we'll talk about that. So I'll basically, in about 30 minutes, she's going to look at me and tell me, I'll see where I'm at for slides. I'll gauge you guys as an audience. If you want me to cut it to 50 minutes, so we can do a little bit of Q&A, or you can hang back and we can do more Q&A. I have time, so I know, but your time is limited and valuable. So we will go through the world in about an hour. So. Crude volatility, and if you haven't listened to the podcast, you absolutely should, because there's a wealth of knowledge in there. I'll try to turn this into one if I can. If not, I'll just make sure this is posted for you guys. But so the world is pretty volatile. We're going to cover everything from basically US Shale and the global oil market all the way into energy transition and ESG. And I will tell you, I mean, there's a lot of reasons I think it's really important to pay attention to ESG and the energy transition. And we're going to start with that. I've not done this before, but we're going to try this now. So I just need to raise a hand of the group here. Are you bullish or bearish? Like, where are you guys at? Are you bearish on oil prices? Raise your hand. Are you bullish on oil prices? Raise your hand. All right, that was the point. It's a pretty big groupthink in the industry. Everybody's bullish on oil prices. Now, I'm not going to debunk that, but there's a lot of reasons I would like to unpack where that is, because the entire industry, by and large, is pretty bullish on oil prices. Nothing on the demand side should make you bullish on oil prices, especially today. The reason oil prices came off today is because demand data out of China is not that good. So there's nothing globally from a global macro perspective, demand data that should say you should be bullish. Now there's lots of other things that can make you bullish. Certainly geopolitical factors, production factors, a lot there. But that's not necessarily bullish either in terms of long-term business. Where are you bullish on oil demand? Okay. I gave you the answer to that one, but that's fine. And are you bearish on oil demand? Okay, well, that's fine. We're not raising our hand in oil demand. That's fair. All right. So who knows what ESG is? All right. Who knows? And how well would you say you guys are versed in the energy transition? Other than knowing people talk about it, like what is it? What is it comprised of? And what's it going to do? Do people feel really comfortable on that? Okay. So lots of questions though. The reason I think it's really important is because this business, this oil and gas business, and you guys are an oily town. This is different than any other town. You don't get to see pump jacks when you fly in. You don't go to an airport in most towns and see advertisements for hydraulic fracturing, which is awesome. So this town at least owns that it produces oil and gas, but increasingly around the world, that's less likely the case. And we produce oil in Colorado, but you certainly don't see oil ads when you fly into Denver. So major takeaways in this presentation. We're going to start with the oil prices in the market. We'll talk about why everyone is bullish. ESG, and I thought it was funny because I figured you guys could answer that way. ESG and the energy transition in the context of assets. So I'm not trying to, I do spend a lot of time in my podcast sort of ripping on ESG and the energy transition. And I don't mean that in a sort of about-face way, but the reason I want to talk about it is because it does really matter from an investment standpoint. It does really matter in terms of how your assets are actually valued. Because when the energy transition and what we're doing with it and net zero 2050, it gets really complex and really confusing. And it does matter in terms of the labor you have in the field. If people do not believe oil and gas is going to be around in 10 years, it's going to be pretty damn hard for you guys to get engineers into the field 10 years from now. So it's very important that people understand, what oil and gas is, how much we produce, why it matters, and also what the energy transition is and what it's trying to accomplish. And those don't necessarily compute with each other. And it does matter, so education is really, really critical. And what you do have now is a trend in the oil and gas industry to talk a lot about the energy transition without a whole lot of context, and not talk as much about the actual what you're doing in the business and how much oil we produce, why we need it. I mean, we're producing a lot of oil and we're consuming a lot of oil, and that's why you guys have a job. But it's really important that that education is out there because most of it's about the energy transition right now. And the labor piece is really important because I don't know how many universities you guys go to or speak at or work with, but it's increasingly hard to get people in petroleum engineering programs today. Everyone in a petroleum engineering program already has a job, and it's increasingly hard to get kids recruited, and people are even having retention issues within their own oil and gas companies, because younger people don't know how long this industry is going to be around. That is all really critical to make sure people understand, or you're not going to have the people, and we're going to continue to see a lot of inflation in the business. Now, so we'll talk about US shale and natural gas. Lots of natural gas, obviously low prices. Prices dropped 13 cents today already. Recession and crisis risk. Something I noticed in Midland, and I love the town, so this is no discredit, but I think if you've been following the regional banking crisis and what's going on from Silicon Valley Bank all the way to First Republic that happened over the weekend, if you're following any of that, we'll talk about that a little bit. But regional banks are our big theme right now, and that's because regional banks are, people are pulling their money out of regional banks and putting it into bigger banks that they think have less risk and exposure. Well, regional banks, and there are definitely a few of these in town, and not discrediting any of those, but regional banks also have exposure to oil and gas, something nobody's talking about, because a lot of folks really don't care about the risks to oil and gas, but they are talking about commercial real estate, and regional banks tend to have a disproportional share of, exposure to commercial real estate, and commercial real estate is the next shoe to drop in this economic saga that no one believes is going to crash, but it's a serious issue right now. So regional banks and commercial real estate are something to really pay attention to. And I think there are knock-on effects in oil and gas and the relationships that oil and gas has with regional banks to also pay attention to. So we'll talk about that. High oil prices, we do have, yes, they're $72 a barrel, but they were $83 just a handful of days ago. So high oil prices with an ongoing war, with ongoing inflation, gets pretty tricky. We've never been in a situation where we've had high oil prices and high inflation consistently. We usually have one or the other. Yes, high oil prices are a big component of high inflation, but sticky inflation, high oil prices, a war in Ukraine, big tensions with China and the US, lots of issues with China and energy and energy transition, China's relationship with Europe, all this is really interwoven very, very tightly. So it gets very, very messy very quickly. So oil prices, I put this up at 6 o'clock this morning. Obviously the world has changed since then. So we're at 72 and change for oil prices now. This is largely driven off of worries on China demand. China ripped the Band-Aid off zero COVID several months ago. We should have seen a big pop in oil. If China was going to demand a bunch of crude oil and that was going to be the savior, we should have seen a pop in crude oil prices a long time ago in terms of real demand. So the problem with oil prices is they're a decent gauge right now, probably the single best trading gauge of what the economy is doing or going to do. They're not necessarily always, as you know, oil prices don't day to day necessarily reflect supply and demand fundamentals. So it gets a little tricky there. Something else to pay attention to, and I say this in every presentation, but I think it's really important, is the traded volumes. You can see over a 5-year period how thin West Texas Intermediate crude oil, the traded volumes are. They've really, really come off. And so because of that, we can get really exacerbated swings and moves because we have so many computers and algorithmic trading on headlines. So they can see a bad Chinese data point and they can trade on that. The other thing that everybody's talking about today is the regional banking crisis and what the Fed is going to do tomorrow, which is also a very big deal, and just the softness in the overall U.S. economy. And so if you're thinking we're going to recession, you think the U.S. economy is going to be soft, you think China's not performing, you start making bets against oil. And Brent has come off. That's a big deal because, OPEC, everybody talks about their floor or their desire to have $80 oil. That is partly why they cut output, and partly why they cut output is because of the thinner volumes on oil and because of the shorts that were in oil, and they want $80 oil. They also cut output because I think they did not see China performing nearly as well as the rest of the world expected, and so they cut output going into recession. Unfortunately, OPEC is not very good at demand. They're pretty good at cutting supply or increasing supply. That's about it. Gauging demand and controlling demand is a lot harder of a story. And when you increase prices going into recession, it's not the recipe that you really want for maintenance of demand. So gas prices have come down. This is Dutch TTF, this is European gas prices. That went from $100 an MMBTU down to 12 and change today. So that was in August. We had $10 an MCF in August. You guys know this story very well. It's impacted your day-to-day businesses. I mean, the gas story can't be underscored enough in the US that we had never seen as high gas prices that we saw last year since the shale revolution began. Since the start of this boom, we have not seen 650 an MCF for gas in the US, and that is what we saw last year. So that propelled a lot of companies to favor gas, or not favor gas over oil, but it allowed companies to target condensate-rich areas, to target NGLs, to target gassier areas, which is great because you can go after the gas drive, that oil comes up with it, it's wonderful. Gas was sexy again last year. It is not now. And so it's come off a cliff, and partly that's because you guys are so good at drilling and producing this stuff. We have a lot of natural gas in this country, and we had a very warm winter across the US, across Europe. That saved Europe, and it led to lower gas prices. But it's that warm weather that has really drawn down, our storage levels are up. And you can see this, it's really remarkable. And I know people know this, but this is production in the US. The black line is oil production, the yellow line is gas production. And it's so important to sort of stare at this because the US is the largest oil and gas producer in the entire world by a decent margin right now. So 12.5 million barrels a day of crude oil, that is a pretty dramatic clawback from the shut-ins we had in COVID and negative oil prices, clawing that way back. And without as many rigs, without as many frac fleets, well, frac fleets have largely come back, but I mean without as many rigs and with inflation, with sticky employment, you name it, it's done this. And I sort of say this not to push back against the bullish thesis, but it's really important to think about that, because when you push this industry and tell them they can't do something, the industry always responds and always performs every single time. And so it's interesting to me because my entire career, I've never met, largely the industry is bullish. And they forget that we're really good at what we do. It's like Marcel saying, it's the gas story, right? We did this to gas because we're so good at producing gas. We're producing 123 billion cubic feet per day. Yes, this is gross withdrawals, but that's more than anyone in the world. It's double what Russia produces. It's a huge amount of production. And this working gas and storage, this really tells you the story. This is our, the top line for storage volumes, bottom line. Whenever the storage goes up, prices go down. And so we have a lot of natural gas in storage. Also really important to realize is that we have a lot of storage. This is billion cubic feet. Europe does not have that level of storage. So when you hear Europe's storage levels are full, yes, they're full. They filled it up with Russian gas when it was flowing. They filled it up with our gas over the summer. Then they had a warm winter. And so they have gas in storage, but they don't have the volumes of storage that we do. So if winter comes again and it's not as warm as it was last time, they will go through that storage because they aren't producing natural gas and they don't like natural gas. And it's really important, again, for talking about the energy transition and talking about natural gas and what you guys do, that we don't conflate, that we don't mix these things up, because you need to, there's no one that's gonna promote this industry except for the industry itself. And so the producing your own natural gas in your own country or getting it from other democratic countries is pretty important in the context of energy security, is extremely important in the context of national security and also economic security. So where are we in oil demand? This is IEA's outlook for oil demand. You can see that in the back half of the year, they expect demand to outstrip supply. That was pretty interesting, given this same piece of document. This was a document that I paid for, so you didn't see this. But this is oil demand from the IEA. OPEC has the same bullish outlook on oil demand. But the same day this came out, the leader of the IEA, the International Energy Agency, Fatih Birol, came out with an op-ed in the Financial Times, and he said that the energy transition was going a lot faster and more accelerated than people think. It was going really well. That same day, he has a report that comes out that says we're going to demand 102 million barrels a day of crude oil by the end of this year. Those two things they're not the same. So you can't have the energy transition off to the races and also have oil demand off to the races, because one or two things, so something has to give. And so the reality is the truth just isn't being said. And it's important to understand that. This is a divergent demand outlook. So you can see the EIA is on the lower end by the end of 2023. That's OPEC and IEA. The point is, demand is pretty hard to predict. It's probably not going to be as high as people think. Historical rig count, you guys know this. I love that you have a sign outside by your bank that tells you the rig count every single day and prices. Every bank should actually say that. This looks, you've probably seen this chart a million times. Everybody says, why do we need to look at this? It is important to stare at this for just a minute. And the reason why is that, here's where our rig count is now. Here's gas rigs in yellow, here's oil rigs in red, and here's the total rig in black, and then oil prices. Now, gas rigs actually have not moved down as much as many have thought with the drop in gas prices. And that's really because oil rigs actually tend to move down a little bit when gas prices go down, because that's extra money that oil companies are making that they're not getting. And so you tend to have a shift. And gas rigs, we only have 150 gas rigs. We have 150 dry gas rigs, and we're producing 123 billion cubic feet per day of gas. I mean, we know how to do this. It is not difficult. If we built a pipeline out of them ourselves, we'd be producing even more. So the point is, though, that this is where we were, 2012, 2013, 2014, prices crash. We come down to here. We didn't go back to those levels. We didn't need to go back to those levels because everybody was doing better. And the same thing goes for here. And this is actually where we flipped and everything went disproportionately horizontal drilling, especially here in the Permian. This is where we were pre-COVID, and we're not going to go back there. We're about at the levels we're at. And that is saying a lot, because we are producing 12.5 million barrels a day with less than we were. So we're going our way back and doing more with less. That's despite where we are for the regulatory environment. And it is really, really important to talk about the regulatory environment, because you guys increasingly say, the Permian Basin, everybody who does the Dallas Fed survey, and I work with operators, I work with service companies, increasingly everyone says the burden of the regulatory environment, even though it's not perfectly concrete and you know exactly what regulations are coming down the pipeline, the concept is that you do have an administration who is not in favor of domestic oil and gas production. And that does not bode well for long-term investment decisions. Nor does it bode well when the President of the United States gets on TV during the State of the Union and says, well, we'll need oil for 10 years, maybe more than 10 years. 10 years is not a runway for investing in a business, especially a business like this, when it's this capital intensive. So it's extremely important, and it does weigh on the market, in addition to all the other things that the administration has done that is against oil and gas. Draining the SPR to levels of, this was just in days of cover, in days of demand cover. We were here with 35 days of demand cover, 30 days of demand cover at a 20 million barrel day demand market. Now we're here. So we've lost a lot of days of cover. That is, to all of you bulls out there, this is part of the bullish story. We are nearly guaranteeing ourselves higher oil prices in the future if we do not fill up this SPR. This is a big deal. If there was an issue in the Taiwan Straits, if we were to dabble in a kinetic war with China, this is going to matter, and this needs to be filled up. But we have to, this administration is pretty lost when it comes to hydrocarbons and actually understanding them. And so there's a big debate in the White House, and I think with the Energy Administration, on what we do with the SPR. Now, permit approvals, also a very big deal. Not so much here, especially in Texas, because you guys don't have federal land like the rest of the country does, but in places like Wyoming and places in Colorado where there's federal land, but especially in places like Wyoming, even in North Dakota, anywhere there's federal land, Alaska, this is a very big deal. Places that we were drilling and producing for oil and gas, we are still drilling and producing for oil and gas, but we're not getting the permits. So that's pre-administration, that's Trump, this is Biden. Permit approvals have definitely come off. The website where you get this data, the data's not there anymore. So that's a pretty big deal. If I can't get BLM data for permit approvals, that's an issue, and it's not transparent by this administration. I have a problem with it, being a big data person and a nerd. But the point is, so permit approvals are down for federal land, re-up. So if you want to reapprove your permit, your existing permit, it's going to expire. Every administration, Trump, Obama, you name it, they reapprove those permits. This administration is not reapproving those permits. This will all have a long-term impact in oil and gas development and oil and gas production in the U.S. And this is something that I do think the industry needs to be talking more about seriously, because they have to, you have to get Wall Street and you have to get people to understand what's going on. You can't just duck and cover and say this is going to be fine, because if this continues, it's not going to be fine. Okay, the rest of the reason why this energy transition and stuff matters for investment, especially for natural gas and what you guys do on a day-to-day basis, and 10 years from now, this is the G7 energy communique. So this is what came out of, this G7 meeting that was in Japan. This was a big deal between Japan and the White House. Have been talking about this for nearly 2 years on what this communication document was going to say in terms of actual investment in oil and gas. Now, it basically said nothing in terms of oil. And you would have thought that given the war in Ukraine and the energy crisis we've had since that began, and even before, that it would have said a little bit more on natural gas, and it didn't. So the document comes out on April 16th. It's heavy. It's a very progressive document in many ways. It talks about a lot of things you wouldn't really expect to be in a G7 energy communique. But, and I might have missed my little, there we go. Investment in the, so essentially it says, 69 out of 72 bullet points, you read through the entire document, which it did, which was painful, it essentially says that, it might be appropriate. Investment in the gas sector can be appropriate to help address potential market shortfalls provoked by the crisis. And it gives all these qualifications. So the problem is, this is not exactly, I don't know if you're investors in the room or your private equity backers or your bankers, if might be or could be is really what folks want to hear when they're putting billions or millions of dollars into a project, especially like LNG, we're having trouble in the US getting dollars to come in to build LNG export facilities. Not because we all know in this room, and most people outside of this room, most people in the world know that we're going to demand natural gas for a long time. But it's this type of communication that says we're not going to demand natural gas for a long time, or is very iffy on it, that prevents people, bankers, private equity guys, everyone getting to the table and putting their dollars, putting their money where their mouth is and actually investing. And so if we don't have these export facilities, that 123 BCF a day is just sitting there in storage, and we could be moving that all around the world, game-changing energy security for everyone, lowering CO2 emissions like crazy, especially in Asia, but we're not, because the movement against oil and gas is so big. And that's why it's really important to understand the energy transition and what people are doing. This also came out of from on the back of the G7. This is, again, the International Energy Agency, IEA. This is their projection in their net zero, and super important. So a lot of folks talk about net zero, and I understand companies are going, and I do rip on it, and I'm critical of it, but that's because companies talk about going net zero by 2050 for emissions, right? They say it's emissions. But the problem is that net zero by 2050, that came from the UN, it came from the International Energy Agency about net zero emissions globally, which means that what that actually means is, according to the IEA, based on that G7 document I just showed you, this is what they say for nat gas. So nat gas, the oil and gas industry thought was going to be safe because we all need it. We know we're going to need it. And if you listen to Baker Hughes' earnings call, if you listen to ConocoPhillips Investor Day, if you listen to Liberty Energy's earnings call, all of them are doubling down on nat gas like crazy, because we all know that nat gas is going to be the long game. But this is the drop. You have to go to you have to go to a quarter of natural gas consumption today. The world consumes 400 billion cubic feet per day in natural gas. We're going to have to go down to a quarter of that by 2050 to get to net zero. That's according to the IEA. That's a big problem for investment. So this is the same thing that came out of this document. This is LNG trade. So if they're telling you here's our capacity, but here's what our trade's going to be by 2035, it's going to go down. No one's going to invest in this. No one's going to invest in put long-term contracts in LNG. This is really problematic for day-to-day business and oil and gas business. So this gets really cumbersome and really constraining, and is messy. And the energy transition realities are this. So this document, if you haven't read it, JP Morgan's annual energy document is fantastic. It's available to the public. And Chris Wright and others talk about this. But I don't think a lot of people really appreciate is that, here's our share of primary energy since 1965. I don't call them fossil fuels, I call them traditional fuels, crude oil, natural gas, and coal. I think we need to remove fossil fuels from the vocabulary, just like the K in fracking was never there, has a pretty negative connotation. So here's where we were in 1965, about 95%, and here's where we are now, just over 80%. So we're still using a lot. And the point that people say about this is that you have to add energy into the mix, because we tend to consume more, not less. We have never had an energy transition ever where we've replaced a fuel. Coal consumption, global coal consumption is this. Coal production is in purple, coal consumption is in orange. That's global coal consumption. Despite all the rhetoric on the energy transition, we've continued to increase coal consumption, largely from India, largely from China, but still, it's very real. This is natural gas. So those documents on natural gas, I do have a huge bone to pick with, because this is natural gas production and consumption for the world, 400 BCF a day. It only has one way to go, and that's up, especially if you're trying to decarbonize, if you're pulling coal out of your system, if you are adding renewables, and they are incredibly intermittent and they're poor forms of power, you are damn sure going to need a lot of natural gas. So absolutely, if you're a company, you need to invest in it, but you also need to be out there talking about the story and explaining. I mean, every investment thesis is a story. To get investors and everybody to the table, you have to be telling a story. And I do not believe this industry is they're not telling the whole story. They're telling pieces of the story and hoping that everything's going to fall into place. And it's a lot messier than that. And this is the problem. So this is John Podesta with the White House. He's one of the big climate czars and running climate change stuff. He came out and said this energy transition is bigger than the internet. So that's a bet. I don't think, it's not bigger than the internet right now. It's also wind, solar, and batteries. That's it. It's wind, solar, and batteries, and stop producing and using oil and gas, which is very difficult to do. That's the article that the IEA came out with, that clean energy is moving faster than you think. Same day they said we're going to be consuming 102 million barrels a day of crude oil. This is our exports of LNG in purple. You can see we're exporting about 12 BCF a day. Every molecule that we can get on the water is another molecule in terms of like stabilizing natural gas prices abroad, lowering those prices, and actually the more molecules we put on the water, the more stable we create a global market for this natural gas. So there's huge benefits to it. Skipping really quick into US Shale, I know we're on time, but okay. So shale companies are not, US shalers, you guys in the room, are not reinvesting. We're at an incredibly low reinvestment rate in this black line here. This will catch up with us. Now this goes with the bullish thesis if you're bullish on oil and gas, but I have a problem with this. So you can't have your cake and eat it too. You can't say the reason it's this low is for what reason. So it's kind of artificial there. So a lot of the oil and gas companies say, absolutely, we need to return money to shareholders. 100%, I agree with you. But shale industry burned through tons of cash, tons of money, and now they're returning money to shareholders. But also, they've leaned into the energy transition a lot. And also, they have a lot of ESG and energy transition pressure on them, and they have investor pressure. And they're trying to get into long-only portfolios. And they're trying to get managers to advocate for their company. And so it's not necessarily working that way. So, we have big companies that are spending billions and billions of dollars of CapEx in energy transition stuff, into wind, into solar, into batteries, into carbon sequestration. I'm not saying you shouldn't reduce your methane emissions and you shouldn't do what's right. You should absolutely do that. But it's more complicated than that. And when oil prices were higher than they were right now, and you're putting the money into energy transition stuff, it takes a long time to get a return on that investment, if ever, because a lot of the stuff doesn't actually return money. So if I'm a shareholder, I don't know if that's the best way to go. Nor do I think share buybacks at these price levels are necessarily the best way to go either. Oil and gas companies make money hand over fist right now from oil production. So the logic would hold, you might want to put a little bit more into drilling and producing oil. But it's problematic because then shale would rev up, except this investment rate doesn't work and it holds this bullish thesis, but eventually the tailwinds for doing this and being sort of anti-oil and gas domestically was also Paris Climate Accords, the administration jumping into the Paris Climate Accords, re-signing the Paris Climate Accords, the Climate Change Executive Order 14008, canceling Keystone XL, you name it, tons of stuff. If there was a shift in politics, which there could be in the future, and we pulled out of the Paris Climate Accords or did different things, this thesis might not look quite as clear. So I think it's really important to understand this from, especially cash flow from operations. If you're making that much money from operations, it is very hard to me that, spending a little bit more money on producing a little bit more oil, if you have that bullish of a thesis, that makes sense. And also the share buybacks, companies are just spending so much money on share buybacks, which is also that's the prerogative of the companies. However, we tend to have transitory investor pressure, as in investor pressure shifts. Investors in 2015 wanted everyone to buy into the Permian at any and all costs. $50 a barrel, they didn't care. They wanted everyone here in the Permian Basin, so everyone did it. They took on massive amounts of debt, and then investors turned around and said, now we need you to make money. And that was slightly more difficult to do now that everybody spent all this money. And so that's an example of that investor pressure. And now the investor pressure is return money to shareholders, share buybacks. Share buybacks don't necessarily return money to shareholders. Share buybacks is the companies are telling you that my company is not valued at what I think it should be valued, and therefore I'm going to do share buybacks. At some point, if the company does not get valued at what the company thinks it should be valued, then the share buyback thesis has to go out the window as well. So I'm just saying we have to put all this in context of what we should be doing with this money. Dividends are great. That's a great way to get a long-only portfolio, but the share buyback thesis is a little bit tricky, and just something we should put in context. The compounded risks and uncertainties are also huge. This is just a list of the big ones from when I talk to clients, from what the Dallas Fed survey, from what people talk about is, overall uncertainty in terms of prices. Even though most people are bullish, there's still a lot of uncertainty. The price outlooks and the variability in those outlooks, recession risks, bank failures, This looming regulatory risk that people can't really quantify or qualify perfectly, but they know it's there, and they don't know if we're going to refill the SPR or not. The labor availability and shortages, really serious, as I said. It's real. You guys feel on a day-to-day basis now, but we're definitely seeing it in the future of just being able to have people educated and in the field. This is not just oil and gas. This is every business of getting people to work. But it's very serious for oil and gas, given all the reasons I mentioned and the fact that oil and gas is not a loved industry. And so people don't think it's going to exist, and they don't think they want to work in it. Permitting delays, that is really serious. Inflation and rising costs. Inflation again, supply chain issues. So if you look at actual production and how it's stacked up and where you sort of want to be, where you don't want to be, and you guys are in the Permian Basin, so I don't know how much you are deeply involved and know what goes on in maybe the Marcellus or Colorado, but I put this chart up for folks in Colorado a lot to show where Colorado's at, where Alaska is, in California. These are declining production states. They shouldn't be. They got the resources, but they are from the regulatory perspective, because in Colorado we had some significant legislative changes for permitting where companies can't get permits, or they reduce those permits significantly. And so production in blue has really come off from the highs and come down. Alaskan production is in red. It's steadily declining. California production, that's really, really serious. So it's the state to follow, because California loses about 3,000 barrels a day every single month in production, because that's a state that is not favorable to oil and gas. And it's something to really appreciate, because this is a state that's favorable to oil and gas. This is a drill, baby, drill. If you want to do business, you can do business here. And that's incredibly important for all business, not just oil and gas. That's New Mexico just by comparison. I always show this for Colorado, because the states that are not open for investment, the money will go elsewhere, the businesses will go elsewhere. We have plenty of companies based in Denver, in Colorado, that have assets in New Mexico, and they've been off to the races. And the reason I point this out is because, when we talk about oil and gas production, where it's flatlined or declined in some basins, flatlined production in North Dakota, flatlined production in Powder River Basin in Wyoming, flatlined production or declining in Colorado, flatlined production in Eagle Ford. It's not in the Permian, especially in the Delaware. It is, no matter oil prices, it is up and to the right. And you can look at individual companies and break out their production profiles, and that's what you'll see. What prices you need, you guys know this well. I don't pretend to be, to say this is correct. Again, this came from the Dallas Fed survey, but I like it. And this is when I go to DC or I go abroad, I walk people through this. But I do think the inflation piece is serious. It's something that was finally talked about a decent amount toward the back half of last year. I think the inflation piece of getting people in the field, actually getting equipment, everything, it's a very big component. So the level of being able to produce a barrel of oil, yes, we can still do it at $75 a barrel. Are your margins a little thinner? I'm guessing you would say yes, your margins probably a little bit thinner, because everything costs more. And that inflation piece really matters, and we'll get into that shortly. Average lateral length, I tell a lot of people about this. You guys know this because you do it, but it's awesome. And I was in the field today, and obviously I can't see the lateral, but knowing that I'm standing there and it's going out 3 miles is pretty incredible, because that feet on average here in the Midland, the average well is 12,000 foot. And that's just impressive on average, because, a handful of years ago, it was 8,000. And those incremental movements are serious. And so when people are, bullish on oil prices, I understand that, even though I have some bones to pick with it. But I'm pretty bullish on the rock, and I'm very, very bullish on the industry, because these incremental movements, this little bit of changes in understanding the rock a little bit better, being able to drill slightly longer laterals, being able to consistently drill slightly longer laterals, and not having a massive diminishing marginal returns when we're normalizing on the barrels per foot basis, that is huge. And I can tell you, lots of people don't understand this. I don't think folks on Wall Street truly understand this, because they don't love your business anymore. And I don't think the Saudis understand this. I don't think a lot of folks understand these incremental shifts. So the rock has a lot left to give. We just have a lot of above ground sort of thinking. And same across the country, the laterals have gotten longer. Now, actual completions. And this is where you can actually see that ESG pressure, that investor pressure, really clearly. So the companies you can see this in this is Permian completions, and Permian completions, the bar chart is the total completions. So Permian completions are better than they were pre-COVID, which is impressive, right? So off to the races, everybody's doing great. That's public companies in purple. Yes, there's a lot of them, but you can see the red, which is private companies. they've exceeded the level that they were doing in pre-COVID, which is very, very impressive, because if all these private companies responding to oil prices really quickly, being very nimble, does tell you a lot about investor pressure, because the private companies are able to just go to town and start drilling, completing wells. And they have helped meaningfully contribute to production here in the Permian Basin, and meaningfully contribute to production in the US, and meaningfully therefore contributing to global production, and energy security. This is total US completions. Again, stacked up here, we have not come back almost to where we were pre-COVID, and that's largely because the public companies haven't fully come back yet. They haven't come back in Williston, they haven't come back in the Powder, they haven't come back almost every other basin, largely because of that investor pressure. And this does really matter in terms of US output, US geopolitical leverage, energy security. It's really meaningful and important. That's just total US completions. You can see that's private, again, well above what it was pre-COVID, and that's public, well below what it was pre-COVID. That is your ESG investor pressure, everything weighing on these companies, which is just a reality. And again, this is why I think it's really important for these oil companies, especially public ones, to tell their story better, especially if for nothing else, for share price performance, to say, why we're going to be here for the long haul, and why this product really does matter for the long haul. That's just rig count, public and private rig count. You can see, again, same thing, private companies are ahead of where they were pre-COVID. Public companies are slightly lower. That's Permian. Public companies have come back. We started to see that flip, huge response in just to oil prices. And if we see where they're at, where these companies are at, I try to show this basically to make one point really clearly. The whole tier 1 to tier 4 acreage thesis, we've cored out everything, we've drilled up all the good stuff, we don't have enough wells left. I understand that many people follow that line of thinking, and I don't, and that's largely because the orange rigs you see here are the public companies. They are drilling in the core, they have the core of the core, it's great. But every time a public company buys a company that's not on the core, then they call it the core. So, that core gets extended. But all those purple companies, those rigs, are private companies. And you can clearly see they're not drilling in the core because they don't have that. Well, high oil prices and high gas prices do something wonderful. They de-risk some acreage. They let private companies go out and they're ready to, $6.50 an MCF gas. Everybody, you got wildcatters going for gas. Everybody wants to, it changes the business. And so the purple, another way to look at this is drilled but uncompleted wells. This is just being don't get hung up on what a drilled but uncompleted well is. We can spend 2 hours after lunch, debating that. This is a hole that has been drilled, waiting on completion. Some of them won't get completed, yes, most of them will. But that's all the private companies, and this is all the public companies. So that tells you these are holes that somebody spent money on, drilled them, poked them into the ground, and those are all the purple ones. Far bigger than that sort of cored out stuff, which tells me a lot, especially when we look at, obviously, Permian Basin production is way up. Over 20,000 MCF a day you're producing in the basin. That's just incredible. That's just largely associated gas. The reason that map is incredible is because you would expect, with all the very negative theses on oil production is declining and US shale will never come back, just pull up the Financial Times, read the Wall Street Journal, read Bloomberg, the very negative sentiment on US shale. That's also not positive. I know all the bulls think that's positive for oil prices and oil stock prices. It's not positive for the stock prices because, again, the companies are not telling the story to why they need to be invested in for the long haul. What we're seeing, though, is that productivity is not declined, is not meaningfully declined. So if I've got all these companies stepping out of their core acreage and I've got longer laterals, the thesis would go, okay, the shale skeptics would say, then my productivity should decline. This is Colorado, Wyoming, North Dakota, Williston Basin, Powder River Basin, Eagle Ford, Permian Basin, Anadarko Basin, all into one. That's normalized for productivity. And you would expect that black line, which is 2022, to be smashed down, and it's not. Gas way outperformed last year because gas was so great, which tells you that in the oil plays, folks are targeting natural gas, or we're targeting natural gas. And it's great because that gas drive, again, helped oil. It's a great nerdy story. I love it.